Hello everyone, I'm Jen, your Delaware Realtor. Welcome back to my channel. If you are new here, I am a local Delaware real estate agent that basically covers the entire state because we are so small. So whether you're looking to buy or sell in Delaware, I would absolutely love the opportunity to help you. My information is down below in the description, so please feel free to send me an email. All right, so I have been trying to make this video for a little bit now, but I am still trying to get on a schedule with my newborn. So please bear with me. I promise I will get my life together here shortly. So the last time that we talked in September, rates were sitting at 7.31%, and they went up from there. Rates peaked at just under 8% at the end of October. Even though I know that the media was telling everyone that they had crossed over 8%, the national average never actually went over 8%. But that's a topic for a whole other video, and that's not the topic for today. So let's stay on target. For the last 4 weeks, rates have been on a downward trend. We are currently sitting at a 7.22% for a 30-year fixed rate, according to Freddie Mac. It kind of blows my mind that we're talking about a 4-week downtrend and we're still sitting at a 7.22%. But that is the reality of where mortgage rates are, and I, for one, am just very happy that we're not seeing them rise. Let's take a deep dive into this. Why are we seeing the movements that we are seeing? Mortgage rates are driven by a complex set of variables. And honestly, I don't really see it being explained properly outside of certain circles. I see a lot of media outlets that think that they need to dumb it down for their audience, that it's too complicated. But that's not what you're going to get here, because it is so important to know what the variables are and how they interact with one another, because this can help us make better predictions to what the market is going to do in the future, which helps you to make better informed decisions. Back when mortgage rates were on the rise, they were primarily driven in that direction by the Fed's hawkish stance and commitment to raising rates and keeping them there for an extended period of time. But what was more consequential to this rate spike that caused them to hit a 20-year high of almost 8% was the U.S. Treasury bond market sell-off, which happened in the beginning of October, which was sparked over concerns of government spending and the federal deficit. As we've talked about time and time again, mortgage rates are closely tied to the Treasury bond market, and they move with the Treasury yield. So as the Treasury yield went up and hit a 17-year high, it put upward pressure on the mortgage rates. Since then, cooling inflation and a softening economy has taken over the headlines. Cooling inflation has allowed the Fed to shift its policy and put a pause on rate hikes. A softening economy has caused Treasury yields to move lower as investors seek out more safe haven assets. The combination of these two factors has caused mortgage rates to drop to the lowest level in over 2 months. Let's take a moment and look ahead. There is a lot of buzz in the media about potential rate cuts in 2024. And personally, I am approaching that with a degree of skepticism, because as much as there is a chance of rates to decrease, there is an equal chance for rates to increase as well. I anticipate that rates are going to fluctuate in the high 6s to mid 7s for a little bit of time. And the reason I feel that way is the economic factors at play are going to take a little bit of time to unfold, a little bit longer than many are anticipating. Significant rate cuts by the Fed are only likely in the event of a severe recession, meaning that they would need to stimulate the economy. However, such measures are contingent on inflation being under control. The Fed's primary concern is to avoid stagflation, which leaves them with limited tools for intervention. As long as inflation remains above the Fed's comfort level, the likelihood of rate cuts seems remote. Even in the case of a recession, it's most likely that rates are going to remain just where they are. As you can see, predicting mortgage rates means that you need to understand a complex set of variables. And let's be honest, I don't have a crystal ball, so this is really just my best guess. Although I'm super proud of myself, because the past mortgage rates updates that I've done, of the predictions that I've made, they've been pretty spot on. So you have to keep watching. Make sure you subscribe to the channel so that you never miss an important update or an important prediction. Thank you so much for watching this video. I really hope that this video helped. If it did, be sure to give me a thumbs up. Be sure to subscribe to the channel. If you are a buyer that is looking to purchase in Delaware, I would absolutely love the opportunity to help you. My information is down below in the description, so please feel free to send me an email. If you are a seller that is looking to sell your property in Delaware, I would also love the opportunity to help you. There is a link down below in the description for an instant valuation of what your home is worth. Once again, I really hope that this video helped. If it did, be sure to give me a thumbs up. Be sure to subscribe to the channel, and I will see you on the next one. Hey, are you thinking about moving to Delaware? You should check out this video right here. And if you would love to tour Delaware new construction homes with me, check out this playlist right here. And don't forget, subscribe to my channel.